Hello and welcome to Amun State of Crypto Brainstorm, where we come together once a week to discuss the latest trends and analysis in the crypto world. All opinions expressed by Amun staff or guests of the podcast are solely their own opinions. This podcast is for informational purposes only and does not constitute any form of investment advice. This podcast is powered by BlockWorks Group, the only events and podcast production company I trust. For access to the premier digital asset conferences and in-depth podcast content, visit them at blockworksgroup.io. I promise you will not be disappointed. My name is Hany Rashwan. I'm your host, and I hope you enjoyed this week's session.
This week, we will be discussing the Bitcoin ETF. In light of the recent rejection by the SEC of the latest application, we want to investigate what this means and what's next for the industry. I'm Hany Rashwan, and joining me today from Amun are Ophelia Snyder, our president, and Laurent Kssis, our head of ETFs. We also have a few friends from outside the firm joining. We have Matt Hougan, MD and head of research for Bitwise Investments, and Barry Pershkow from Chapman and Cutler. Laurent will be leading this, and Laurent, the floor is yours.
Thank you, Hany. So good afternoon all, good morning. The road to the first crypto ETF has been a long journey for everybody, particularly in the US, and there's lessons to be learned. So we just wanted to review how this is being taken by the community, the industry, and particularly by Bitwise, as the SEC has published a highly detailed 112-page response disapproving the filing with the New York Stock Exchange. So the main issues we can see is related to market manipulation. It means that Bitwise and other Bitcoin ETF issuers won't be launching in 2019. It's a big disappointment for the industry, and disapproval doesn't sound positive. However, we believe this could actually be a blessing, and in fact, a productive step to the journey towards getting the SEC to approve a crypto ETP or ETF or a trust in 2020. To put this in context, historically, first-of-kind ETFs, so for instance, bond, gold, commodity, leverage product, have required multiple years of filing, deliberation, response, and refile. In our opinion, a negative outcome would have been short, potentially same issue as before, non-eventful response. This wasn't the case, and in fact, it was seen as the specialist as thorough, updated, and clear guidance of what the regulators came back, and hopefully now we can see a clear vision of what the issuers need to do in order to refile for a potential approval. So we have Matt, who's on the line, and we look forward to hearing some of his comments and some of the issues that he feels may actually be productive to respond now to the SEC, and we'd like to hear how he feels about it.
And I think, Matt, one of the things that we get asked a lot by people in the industry, and something that I think you should touch on as well, is the who cares element. So why do we even want a Bitcoin ETF? Does Bitcoin need an ETF? So hit on that as well with respect to why it is that this is needed in the first place.
That's great. Yeah, thanks, Laurent. Thanks, Hany. I'll hit on that first and then talk about the clear pathway that I think the SEC laid out to go from here to approval, hopefully in 2020. Why do we need a Bitcoin ETF? The reality is there is, as you guys know, massive wealth creation taking place in the crypto markets. And that wealth creation is easily accessed by institutional investors and to some degree by small retail investors through apps like Coinbase. But the vast majority of wealth in America, at least, has no safe, secure way to access everything that's going on in that space. What an ETF would do is twofold. For one, it would open up the financial advisor marketplace to make their first investments into crypto. The financial advisor marketplace in the U.S. accounts for about $24 trillion in wealth. It's as big as the institutional market. And right there now, there are simply really no products that make it easy for those investors to allocate. They can allocate through private funds like the ones Bitwise offers or offered by a number of our peers. But it's not easy and simple the way an ETF would be. Secondly, I think an ETF would be safer for most investors than accessing crypto through an app where they run risks of their phone getting ported or their password being lost. So really for everyone but the institutional market, the crypto ETF would allow people a safe, simple, secure way to access the wealth creation going on in crypto. And I think that would be great for them. It would be great for the crypto industry. And I hope to see it soon. We have been working with the SEC over the course of the past year on our filing, and we stand on the shoulders of people like the Winklevoss twins and many others who filed with the SEC years ago trying to launch a crypto ETF. And the good news is that we're closer than we've ever been before. So we got a 112-page response from the SEC. It was detailed. It was, painful to read in parts. But they did mention a few clear pathways by which, with additional data and research, at least we hope we can get to approval. The most critical one was developing the thesis that the regulated Bitcoin derivatives market on the CME is a significant marketplace. So we did a lot of work on that. It's a large market. It now regularly does almost $300 million in trading volume. But the SEC wants to see more data showing that it is the actual source of price discovery in the Bitcoin market. And that's fun, exciting, and important research to do. So, that's just the tip of the iceberg. Lots of things to discuss. But among the most important things was showing that the CME futures market, as a regulated market, is really a fundamental source of price discovery in the Bitcoin market. And that's one of the things we're going to be working on.
And Matt, I think one of the things that I would also love to hear more about is who's the target audience here for the American Bitcoin ETF? Is it retail investors buying this through Schwab and Fidelity, or is it institutionals? Is it funds? Is it high net worth? What specifically drives you and where you think the initial demand is going to come from here?
Yeah, that's great. It's a great question. Both of those audiences would invest, but the real primary audience is the financial advisor marketplace, the independent financial advisor who has 200 million to $1 billion in assets from a handful or up to 100 individual wealthy families. Those are the people who control the vast majority of retail wealth in the U.S. The self-directed market is actually very small. The number of people who manage their own portfolios, who trade on Schwab or E-Trade, and are maybe today managing their crypto assets in Coinbase, they actually only account for about 5% of the wealth in the U.S. About half of the wealth and the vast majority of individual wealth is through the financial advisor marketplace. And those are the people who would use this ETF. It's similar in many ways if you go back almost 15 years now, or maybe a little more than 15 years, to the advent of the gold ETF. Gold was obviously an idea for people to allocate in their portfolios for many years. There were ways for people to do it, whether by buying gold mining stocks or going out into the physical market and acquiring coins or bars directly. But it was difficult, it was unwieldy, and it didn't fit into the systems and custodial processes that financial advisors use. Once the gold ETF was launched, investment into gold rose significantly. It became part of everyone's discussion of what should be in a portfolio. And the reason was that it made it easy. And what a crypto ETF, what a Bitcoin ETF would do would be to make it easy. So it's not quite institutional investors, although they would use a Bitcoin ETF. And it's not really retail in the sense of individual investors who self-direct their own portfolio. It's actually in between those. It's the financial advisor marketplace, which really is the source of most wealth in the U.S. And is the primary user of ETFs in the U.S. And those would be the people who would be best served by having a Bitcoin ETF at their disposal.
Got it. That's super interesting. One of the other questions that comes up is, isn't there a Bitcoin ETF already listed in the US? I hear about this Grayscale Bitcoin Investment Trust. And so maybe you and Ophelia can gang up on this, especially because we also have listed Bitcoin instruments, although not in the US and definitely not an ETF. So maybe you, Ophelia, what is this Grayscale thing? Why is it not an ETF? What's an ETN? Because we hear some products elsewhere of that variety. What's an ETP? What's listed trusts, etc.?
I'll take a short swing, and then Ophelia can finish them off. GBTC is the only exchange traded version of Bitcoin that you can buy in the U.S. through a Schwab account. It found a regulatory loophole that allows the shares to trade on the over-the-counter bulletin board market, what we used to call the pink sheets. And the problem with GBTC is it's a closed-end fund. There are a limited number of shares, and it trades at a substantial premium. So over the course of the past few years, it's traded at a premium that ranges from about 10% to 100%. And if buying Bitcoin is risky enough, buying it at a 10 to 100% premium is insane. The real risk for people who are acquiring GBTC today, I believe, is that when and if a Bitcoin ETF launches, I would suspect that premium to disappear and perhaps for the shares to trade all the way to a discount. So there's substantial risk of loss if you're buying it. I understand why it exists. It's the only way through the regulatory challenges of today to get a listed product, but it's a thoroughly imperfect product. And I think that people who acquire it do so at great risk.
Ophelia, do you have anything to add on the Grayscale product, and then talk a little bit about ETNs and ETPs and such?
Sure. Happy to give some more context around that. So part of the GBTC product is really that it has a delayed creation schedule as a result of its regulatory status. So unlike a traditional ETF or an ETN or an ETC or sort of any of the other related products, the GBTC products you can only create new supply of them on a 12-month lag. So what that means is effectively institutional investors can come into the product today at the net asset value without the premium, and they can then liquidate that position 12 months later on the open market. And those dynamics are very different than an ETF, right? So a traditional ETF has effectively continuous creations and redemptions, which lets you sort of match two disparate supply-demand curves. You have supply and demand for the box, call it an ETF, an ETN, whatever the actual structure is, as well as a supply-demand curve for each of the individual components. And to make those two things trade in line, you need to basically be able to adjust supply and demand in the packaged product. And the GBTC product suffers from an inability to do that in real time. And so increased market demand can result in these very large premiums being created. And it's a little bit different when you think of it sort of structurally and operationally than, products like a more traditional ETF or an ETN or some of the work, Bitwise has been trying to do in the US. And I think that's really a critical point when you think about investing in these products, to really understand the differences in product construction and, what the real deltas that can create in returns. Our products, for example, absolutely function on that sort of daily create redeem basis, which lets them really trade in line with the crypto market versus having, some of these related issues with premiums and discounts. And, these are obviously not available in the US, and they're, for the European market and especially for Swiss market, but it's a sort of a similar architecture to some of what people talk about when you think about ETFs and ETNs and ETCs globally. ETNs specifically, you also have that sort of delta between physical and synthetic, especially on the notes side. And I think that can also significantly impact the way these products trade, especially depending on how that hedging is done and what your counterparty exposure looks like. And I think in crypto, we've sort of seen a wider range of these applied and sort of a wider range of different product constructions. And I think we've yet to really see, especially for the American public, something that, really looks and feels like the more traditional products on the market and the ones that are, let's call it institutional grade structuring, but available and accessible to a retail market.
Thank you for that. Color is extremely helpful, Matt and Ophelia. We also have Barry on the line, and Barry is today a partner in one of the premier DC law firms and an expert on ETFs. He's also had an extensive history both at the SEC as well as his current legal practice, and has had a part of some of the most historic recent ETF launches, including the first leveraged and inverse ETFs and the first leveraged and inverse commodity ETFs, the first long short ETFs, which sound quite risky and probably took a really long time to come to fruition and develop. And prior to his time now at Chapman, Barry actually served as senior counsel with the SEC. And so a lot of people in the community that is the crypto ecosystem are now suddenly really engaged with things like proposed rule changes and common periods and all these fairly specific procedures and techniques from the perspective of the regulators, from the perspective of the legal and regulatory frameworks here. Why is this taking such a long time, especially considering some of the other things that have been accepted? And most especially in this case, considering that there is a product out there, like Matt said, on Schwab, available to retail American investors that has a premium of NAV that varies between 30 and 150%.
Yeah, that's a great question. Maybe the SEC is living in dog years, and it takes them a long time to get around to what we think should be dealt with in short order. But you're right. It does. The leverage inverse funds and the first commodity funds all took a long time. In the case of leverage inverse, it was 7 or 8 years. In the case of Presidian, which is the most recent non-transparent ETF approval, I think they were up to something like 9 years. So I think Matt Hougan's right when he says that this takes a while, and there's a back and forth and a period of time that you've got to go through with the staff to get them comfortable with the data. Frankly, I think they tend to approach things viscerally, and there's always a sort of 1 step forward, 2 steps back kind of problem at the SEC. They read the news, they hear about things like Mt. Gox, they hear about hacking, and those are first date impressions that are hard to get rid of. They don't necessarily directly impact what Bitwise tried to do or what others have been trying to do in terms of an ETP, but like I said, they do form sort of hardwired memories about the riskiness of this space in their view, and I think it takes a while to get over that. Consider that we've had in the U.S. years and years, 20, 25 years, 30 years of regulation by exemptive application. When I was at the staff, we went through multiple iterations of an ETF rule. We were there, and there was, 1 or 2 commissioners who stumbled on a couple of issues, didn't really understand them, and all of a sudden it's off the agenda. And that's the way that unfortunately, rule by commission works.
And Barry, I think one of the things that might be really elucidating for some of the folks that might not be as familiar with this, it would be good to also explain how the SEC works and how these decisions are made, how many commissioners are there, etc. Whether they're political appointees or not, what their terms are. Whatever you could provide.
I'll do it from a sort of a high level view, but there's 5 commissioners, one of which is the chairman. The 4 commissioners that are other than the chairman have nothing to do with the commission staff, which are all the people that work for the SEC. That those people work for the chairman, and so in that role, the chairman's got a very powerful position. He sets the agenda for the commission, and he controls the staff and sort of sets the staff in in a direction from a policy perspective. The other commissioners simply have a vote, and that actually surprises them when they first get there. I think many of them get there thinking they're going to do all this great work, and they realize that there's very little for them to do other than to cast a vote. The staff itself are all the individuals that are organized under the chairman, and that's broken into various divisions and offices. And over the years, those divisions and offices have changed names, but they generally reflect, they typically reflect an act, a statutory act that passed, in the case, for example, of the 1933 Act, which is the registered offering statute. That is administered by the Division of Corporation Finance. The 1940 Act, the Investment Company Act of 1940, which regulated investment companies, that's overseen by the Division of Investment Management. Markets, national securities exchanges, the 1934 Act, which is the Securities Act of 1934, is overseen by the Division of Trading and Markets. So what you wind up having, and with ETFs and ETPs, it's kind of particularly acute when you see it work, but because ETPs have overlapping concerns, that is, they're exchange traded, so you're implicating the Division of Trading and Markets in the 34 Act, but they also can be investment companies, and so there's a concurrent jurisdiction, if you will, with investment management. So there's a lot of moving pieces, and because they all sort of offer their shares publicly, at least many of them do, you involve now the Division of Corporation Finance, which is the 33 Act folks. And so when you have all of these people in a room together, they all have slightly different regulatory prerogatives and directives. They also have slightly different cultures. They are working together more and more. And when I was there, it was one of my jobs was to sort of coordinate amongst all those people a bit better than historically had been the case. But I think some of the delays that you see, or some of the delays that folks outside of the building perceive, kind of come as a result of the organization of that building, which is historically not project based, right? It's not like you would see in a typical company or operating company. You don't have, like Apple sets forth a team that develops the iPhone. There's nothing like that at the SEC. It's all very siloed, and so getting together and rowing in the same direction has been a challenge organizationally for the SEC. They've been doing a really much better job over the past several years, but historically, I think some of these delays are vestiges of that.
Got it. So with all of that said, now we know how it works, why it's valuable, how long it has taken before, I think is really important of a point to make, that this is normally a difficult and long process. We do not work very quickly here. Let's go into those 112 pages of feedback and what specifically the Bitwise approach is here. I think in one of the presentations, and all of this is publicly available, and we'll share it in the description of this podcast. Bitwise says something like, our approach is different and simple. A lot of people have made great progress. We're standing on the shoulder of giants, as Matt said, but we're going with a different approach here. So I think it would be super helpful for Matt and Barry to sort of divide this one out and talk about what was the different approach. Let's get into the nuance here. We have time. What did you try that was different this time? And then what was the actual specific response and what that is?
I'm happy to take a swing at why our approach was different, and then maybe I'd love to hear what Barry thinks about the approach and the response. I think there have been three real main efforts to drive the Bitcoin ETF forward. The first was the Winklevoss approach. They filed based on pricing Bitcoin off a single exchange, their own, which they felt they had regulatory oversight of. And the SEC rejected it for various reasons, which I'll explain in a second. The second was Van Eck, which took a clever approach of, rather than drawing prices from the spot Bitcoin market, they would draw prices from 3 over-the-counter regulated market makers who would tell them how much Bitcoin is worth. The big challenge the SEC has had is that the underlying spot markets in Bitcoin are unregulated. So even a well-developed, relatively well-regulated exchange like Coinbase is not regulated at the same level of the NYSE. And the SEC is concerned about the potential for market manipulation. So these attempts, whether it was by the Winklevoss twins with using a single exchange which they had surveillance over, or whether it was with Van Eck skewing the exchanges in favor of regulated OTC traders, were attempts to deal with that issue. Our approach was different. One of the things we knew about the market was that, and this is not a secret in crypto, is that the sort of reported volume and the number of reported exchanges out there is overstated dramatically. That the vast majority of exchanges that list on CoinMarketCap are reporting fake volume and aren't nearly the size that they claim to be. So at the time we did the study, Coinbene was supposed to be the largest exchange. It's an exchange no one's ever heard of. No one we've met has ever traded on. No over-the-counter market maker we know has ever worked with them. And it has no sort of capital history or record. So we were skeptical that these exchanges were real, or at least that they were as big as the established exchanges like Coinbase and Kraken and Binance that we all know. So our approach was really to sort of toss out what people assumed the Bitcoin market was, and instead do a bottoms-up analysis to find out what the real Bitcoin market was. And what we found was that somewhere between 90 and 95% of all the reported volume was fake, and that the real volume for Bitcoin was much smaller than people assumed. So at the time we did our initial study, the reported volume on data aggregators like CoinMarketCap was about $6 billion a day. And what we found was that the real volume was closer to $300 million per day. Now, we did that study during the nadir of Bitcoin volume in March, April, and it's rebounded. Now the real volume is somewhere around $1 billion a day, but it's substantially smaller than the data numbers that you get reported on CoinMarketCap.
And Matt, that is spot volume only, or are you including futures like the BitMEX contracts and the like?
No, it was spot volume only. We didn't include the futures volume. That was a decision that we made, which I'm happy to talk about. But that's a good clarification. It was only spot volume. The reason we did that was because in the Winklevoss rejection, which was the only other Bitcoin ETF application that went all the way to disapproval, and they got, I think it was 92 pages of response back. The SEC laid out 2 possible ways to get approval. Those 2 ways were either you had to show that Bitcoin was uniquely resistant to market manipulation, or you had to show that there was a related derivatives market that was regulated to which you could surveil activity on. The related derivatives market obviously would be the CME Bitcoin futures market. And so our approach was, look, if you took CoinMarketCap at face value and assumed there was $6 billion in trading volume, the CME futures market is not significant. It's tiny. It's a couple $100 million a day. But if you actually did the work, and the work suggested that most of the reported volume was not real, compared to the real volume on exchanges like Binance, Coinbase, Kraken, etc., the CME futures market is regularly between 20 and 40% of the total volume, and that therefore it counts as a significant market. So that was the core of the argument that we advanced. And what the SEC said was it needed additional data, particularly on where price discovery occurs, to decide if the CME futures market was significant. But that was our approach. Our approach was to take the entirety of the real market and examine it and build an ETF, using an aggregated price from all the real exchanges. And that was the approach that we took.
I have a question. Would it be at all possible to deliver to the SEC 3 or 4 regulated exchange that you feel comfortable, as well as VAPs, to trade on? And if you say that the market can absorb, let's say, 200 to 300 million a day, that would be sufficient for a product such as an ETF to actually manage a certain amount of inflows or outflows throughout the day. I mean, let's face it, 200 to 300 million is quite a large amount for any ETFs in the US. So I'm just wondering, wouldn't it not have been possible to highlight, let's say, I think in your last deliberation, you said that 6 out of the 10 exchanges, digital exchange, are now actually regulated. So wouldn't it have been a potential option just to say, look, we're focusing only on 3 or 4, and we know that these 3 are gathering at least $100 to $150 million a day.
I think that's a potential pathway to look at, for sure. I think what the SEC would say, and this was inside their response, was that's a great positive step, but does the activity on the other exchanges influence the price on those exchanges? So I think if you could do what you're suggesting, Laurent, but you would also have to show that the activity on the unregulated exchanges does not influence the price on these exchanges. The SEC made clear that even if we were right that most of the volume on these other exchanges were fake, we still had to show that it had no influence on the price on the real exchanges. And I think that would carry over. So they are looking at the totality of the market. They want to make sure that any activity on any exchange doesn't influence the prices that you're drawing. So I think what you're suggesting is an interesting avenue. Another interesting avenue is something like backed, the new physically backed futures, which doesn't rely on any physical exchange to set the price. The price is set sort of sui generis on backed, and that would be another way to influence yourself. So there are a couple different pathways forward, but I think that's what the SEC would say. They're worried about the totality of the market.
Okay, so that's a very good point where they want to get an overview of the overall market. But if we look at the conventional markets, if we look, for instance, at the equity or even maybe the fixed income, how do you make sure, for instance, in the fixed income market, that there is no potential manipulation where there aren't even any exchanges? So how do you consider that, where all here what we're suggesting is to say, look, there are a couple of APs. These are regulated firms that deal in the ETF industry on a daily basis. They have compliance issue and they have compliance department that dictates where they're allowed to trade. If we just highlight these exchanges, and they are regulated, and we're only going to fit with these exchanges, surely the unregulated one are not going to be able to move, like you suggested, the price of any crypto assets. I mean, at least if we're talking about Bitcoin, then I would suggest that the 6 regulated digital exchange that we have today are significantly robust, and in terms of their market surveillance technology to monitor whether there is any market manipulation at all. So wouldn't that be also maybe an argument to suggest?
I think that's a great argument. I'd love to hear Barry's thoughts on it, and particularly how it compares to the fixed income market. It does seem difficult to imagine that the OTC nature of the fixed income market is superior to the 6 regulated open exchanges that you mentioned. So I think it's a good suggestion.
And while we're at it, Matt, you've really summarized well how the approach by Bitwise in this instance was different. Barry, I think it would be helpful before you get into the questions posed by Laurent and Matt to also just summarize for those listening, well, what exactly happened here? It was rejected, but the nuance behind that, what specifically occurred?
Sure. So the offering itself, right, is done through an S1 registration statement that I think we talked about corporation finance folks at the SEC review. There's no real meat in the burger for those guys. That division will generally approve anything as long as the risks of the offering can be disclosed. So usually you don't have a problem with that side of things. Where things get dicey is when you move over to try to list something. And the Division of Trading and Markets applies a very amorphous standard to list and trade an exchange trade investment product. It's generally got to trade efficiently and be in the interest, in the public interest, and sort of there's a few other standards that they go by, but basically it's a very touchy-feely sort of hold your finger to the wind kind of thing. Which, when you get to a novel product like this, you wind up having some very high up folks in the commission have a visceral reaction to a product or a proposal early. Here, I fear it was negative, and the evidence I have for that is that it's 112 pages. This wasn't written yesterday. It wasn't written last month or even a few months ago. It was written way longer than that. It took a long time for a lot of folks to write that and to run it through the gauntlet of approvals. There are a number of people at various places at the SEC that had to review this document. And so what that tells me is that Bitwise pushed to, or through their listing exchange, they pushed to have this decision, which forced the hand of the Division of Trading Markets to write a denial, something they don't like to do. It's a lot of work. But it tells me that it feels to me like it was someone starting from a no and reverse engineering that no. And as opposed to, for example, Matt, who approaches the product and would start with a yes and writes his, has the exchange write the application in a way that sort of makes sense to him and to a lot of us, right? But I think
you're viewing it as primarily a negative response, right? Is there anything specific that is throwing that off for you?
I view it as a negative response. I don't think there's any other way to read it. It's a denial, but it's I think there are some things that they're holding out in the denial that Matt's pointed out that, yeah, it's a nascent bit. The genesis of Bitcoin is not that long ago, and I think there's a bunch of spots in the denial that talk about where the SEC states that further market development's needed. I don't think they're swayed by the argument if we only had an ETF. In other words, Trading in Markets doesn't want to see an ETF create a deep and liquid market with valid pricing. It wants to see the ETF reflect those characteristics. One way to attack it may be to ask them to flip that notion on its head. And that's historically the way that the SEC's looked at ETFs, which is, once you have a settled market and it's deep and liquid and we can verify the trading, we can see it operate, okay, you can slam an ETF on top of it. But maybe it's time to revisit that. I remember when I was at the SEC, we went through the Greek banking crisis, and there was one, it might have been a Van Eck ETF that was a Greek-based ETF, or maybe it was I forgot, maybe it was Global X. But anyway, Matt, maybe you remember from your earlier professions. But what I do remember is we were closely following the value of that ETF, even as and it never closed off creations or redemptions. People didn't create because they weren't confident in the values. But what interested me was at the end, when the Greek stock market reopened. Do you know what level it reopened at? It reopened exactly where that ETF was. It was the only thing trading in all those weeks. And no one knew what the values of any of the companies on the Greek exchange should be. But interestingly enough, they all opened almost exactly at the levels dictated by that ETF. which told me that, and there are other examples of this, that ETFs can reflect the price of something as opposed to being reflective of it. And by that I mean maybe if we attack it from the direction of saying, SEC, you should give us an ETF on Bitcoin because it will be the valid pricing mechanism for Bitcoin. As opposed, yeah.
I love that. Just to jump in there, one of the arguments we made, which I was surprised was not dug into more carefully. One of the unique things we did with this ETF was we agreed to do all creations and redemptions in kind, and actually to accrue all our fees in Bitcoin. And we did that such that no matter what the NAV was, the NAV could have been $1. The ETF would always have the appropriate amount of Bitcoin per share, and the price that the ETF would trade at would be the price on the open market. In other words, it didn't actually matter to the ETF what the NAV was. The NAV was just a number put out there. APs would have to create in kind, redeem in kind. We would accrue a fee, our fee in kind. But the SEC didn't bite on that. But maybe we need to develop that argument more aggressively, as Barry said.
That's actually exactly how our products work and how they're priced, right? So we've been running our products for, I guess, a little less than a year now. And that's exactly what we do. So we use the gold entitlement model. For people who maybe don't know what that is, most gold, which is sort of a similar market from a trading infrastructure and to some degree regulatory perspective in terms of being sort of a commodity. And the challenges initially with listing gold-related ETFs and ETCs, they priced using a literal number where you say the amount of gold per unit of product. And the reason to do that was exactly to cut through some of these pricing issues. And that's exactly what we did in our own ETPs in Switzerland. We price entirely on an in-kind basis using these daily published entitlements. We take our fee out in crypto proportional to, if it's an index product, the index, or if it's a single tracker, the underlying asset. And the reason we do that is for transparency, but also for pricing consistency. It makes it much easier. And in addition to that, we try to add sort of multiple data points to help people triangulate real prices. And part of that is through this entitlement, but you can also look at data aggregator data, look at different types of data aggregator data. You can publish INAVs and sort of provide as much real-time pricing data as possible, all based off of the actual amount of Bitcoin associated with that product. And it's been our experience that it actually works pretty well, especially given that trading hours for a more traditional product may not match the 24-hour trading cycle of Bitcoin and other crypto assets. It actually means that when the open happens, you're opening at the correct price, and you're able to maintain that continuity regardless of those discrepancies in trading infrastructure between sort of traditional and crypto markets. And it's actually been unbelievably helpful in terms of our products, both from a pricing consistency perspective, but also from a source of funds AML perspective, and sort of keeping assets within the regulated sphere. And that's been a big selling point, and not just selling in the sense of institutional and retail buyers, but also in terms of dealing with regulators about how the Amun products were constructed.
And I was just going to add that I think that there is some more education about in-kinding that the SEC could benefit from. I don't know if it came up, Matt, in your discussions with those guys, but one thing that occurred to me, and I remember this from being in the chief counsel's office, is that one day I learned that BlackRock ETFs the international ones anyway, don't fair value their holdings, which is a violation of the 40 Act. If you take the 40 Act and its guidance literally, you're supposed to, in other words, during the closed hours of the foreign market, the ETF should fair value the security. So if you have Samsung, for example, and it's not trading, the board's got to take into account intervening events between the close of market and the close of the domestic trading day here for the ETF. But BlackRock doesn't do that. because they in-kind things exclusively. They will never vary from the in-kind proposition. And our chief counsel, when I was there, considered that and thought, well, I guess they don't have to because they're handing it out in kind. They're taking it in kind. In other words, we don't care what the value of the thing is as long as you're giving it out, which I thought was a really powerful argument for Bitcoin to the extent that these proposals and proposed products were being done in kind. In other words, rely on that precedent. We don't make we don't make ETFs fair value because we don't care what the value of the thing is. In other words, the NAV is infected with bad values.
It's funny how much precedent we can find for a number of different routes here.
I love that. That's great.
Matt, what's next from Bitwise? Are you guys reapplying? What's your thought process there?
Yeah, absolutely. I mean, look, I don't think there's anything fundamental about the Bitcoin market that means there can never be a U.S. listed ETF. You guys have shown in Switzerland that ETPs can exist, can work quite well, and we want to bring that to the U.S. market. So absolutely, we are going to reapply. We're working diligently right now on exactly which angle we're going to take as we pursue that. You guys have opened up some ideas to me on this podcast, so I thank you for that. But absolutely, we're not going to stop until a simple, secure ETF offering exposure to Bitcoin exists in the U.S. because we think investors want it and we think they deserve it. So we'll be back at this shortly. We have a team of researchers. We're already working on it. We have meetings every week to see how we're progressing. So you can be sure there'll be a new filing from us before too long.
Awesome. Looking forward to it.
This was it from the Amun team. Thanks for listening, and if you have any questions or would like to see your topic on our next episode, reach out to us on Twitter or LinkedIn. We'll see you next week.